Hello everybody! Today in this Trading Bootcamp series we are going to learn about liquidity. What is liquidity? How can we identify liquidity sweeps, sell side, buy side, equal highs, equal lows, and much more. So let's start things off. First things off, I want to give an announcement. I have a new Instagram account where you can follow me and you can track my journey even more with my stories, with my daily videos to also give you some kind of motivation. I'll be linking that in the description as well as a photo right now. All right. And another thing I'm working on is a Power of 3 PDF. This is going to be a full-on encyclopedia of the Power of 3 strategy. So how to identify the accumulation, the manipulation, the distribution, the minor setbacks, the positives, the downsides, every single thing that I know about the ICT and Power of 3 that I can give you guys is going to be in that encyclopedia. I'm still working on it. It's going to take me, I'll say, like another month or two because it's going to be a long journey. But I'm willing to take this challenge and I'm giving for free, absolutely, because I want people to learn, because I want to give people the freedom that I wanted to have when learning, because you don't get that freedom because most things are paid nowadays. Yeah. So I'm just here like to basically teach myself and teach you guys, and that is what makes me happy. So let's start things off. First things, it's the liquidity sweep. Liquidity sweep is pretty straightforward. Liquidity sweep is when you have, let me see this thing that you see right here, these arrows things, I don't know what these lines, like one line, like each one line represents one candle, okay? Just to make things even easier. So yeah, liquidity sweep. First, you need to identify what is liquidity. Liquidity is basically wicks or bodies of candles that create a kind of support and resistance that price can tap and then inverse right after, as you can see from this example. Now, liquidity sweeps are the things that you want to look for the most because they happen almost every time. Not all of them are valid. Just because you can have liquidity runs, but seeing here in the liquidity sweep is basically when you have a sweep of a body or a candle and then a distribution back to the inverse of that manipulation phase. So for example, you as you can see right here, we got this impulsion up and then you got this impulsive move down. This is basically called the manipulation. The manipulation was towards this wick of this candle, and then we inversed and continued the path that we always wanted to go. Now, these can be disrespected as always, and you got to look out for them, and that is basically a liquidity run. Liquidity run is when you don't get that sweep and price just ignores this point of liquidity and continues delivering forward and not manipulating, and not distributing the way it should have. Now let's look into buy side and sell side. These are going to be two of the main concepts that you guys need to know because they are everywhere. And they basically happen everywhere. So buy side and sell side. Buy side is basically the resistance, and sell side is the support. Now, the buy side is basically when you have this wick or this candle. Right here, the candle stop move. It's going to be your buy side liquidity. And how do you identify that? Is when you have the impulsive move and then you start seeing a pullback towards the midpoint or towards this range right here from the impulsive move. That is basically called the buy side, this top wick, and then the sell side is the bottom wick of the impulsion. Now, since this is a bullish example, we usually want sell side to get swept and then a distribution to the place that we want it to. So buy side and sell side can oftentimes be targets and not rather points of manipulation. Now let's look at equal highs and equal lows. These are my these are my favorite points of liquidity. Now, why? Because I trade the Power 3 and you need the accumulation. And for me, it helps me identify the accumulation with equal highs and equal lows. This is basically when two wicks or two bodies are basically at the same level. They oftentimes are not. And if that happens, for example, if this is like a little bit like this or a little bit like this, it's called relative equal highs or relative equal lows because they're relative. They're like less than a tick away, basically. Yeah. But this basically means that there is a high resistance regarding that point of liquidity, and price does not want to sweep that and go deliver down. As you can see from this example, you got this equal low, and then price didn't sweep because it went higher, and did not sweep this equal high either. So it's going to be accumulating. So this can serve as our indicator towards to identifying our accumulation phase on the power 3. Now let's look at these concepts. These look scary at first, but no, they're simple. So external range liquidity and internal range liquidity. These can be targets and these can be points to be manipulated. External range liquidity can be our buy side and sell side. This is just to clear things off. It's not going to overcomplicate. It's not going to be a totally new thing, but ERL, as we say, external range liquidity, is basically when you have the buy side and sell side. And internal range liquidity is when you have these wicks on the move that you want to sweep first. So for example, as you can see, we got this impulsive move up, the impulsive move down towards this midpoint or towards this area inside of the ERL, and then price just goes not sideways because it's still going up, but it's going up a little bit accumulative, as you can see. So for example, we are in a trend line, as you can see, boom, 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 boom. This line over here, where is it? Let me try to see if this line over here, I can make it really beautiful, but this line can be our trend line liquidity if you trade that, but I'm not going to teach that. So internal range liquidity can be targets as well as can be points of manipulation, as you can see from this move. Now let's see low resistance liquidity and high resistance liquidity. So high resistance liquidity is basically what I use for my stop loss. What is a high resistance liquidity? It's when you have a low or a high that is very unlikely to get swept. Why is it very unlikely to get swept? As you can see, we got this impulsive move. We got this. This is not, for example, in this example, this high was our ERL. Now, in this example, this is not going to be our HRL. Why? Because this was targeted. Now, why do I use high resistance liquidity as my stop loss, where I put my stop loss? Because as you can see, impulsive pull back towards the midpoint or towards this area of liquidity inside this HRL zone, as you can see right here, and then price just as you can see right here, the same as this one. Maybe you can call this trendline liquidity. It basically went up slowly but surely. It went up. This is basically confirming that we are not willing to take this low, as even if we manipulate, we are never going to reach this low. We are just going to target this low resistance liquidity. Low resistance liquidity is the same thing as internal range liquidity, but is when you have more wicks, therefore meaning more points of liquidity, more points where price could manipulate into. That's why I love low resistance liquidity as well, and I love high resistance liquidity because as I said, I use high resistance liquidity as my stop loss and low resistance liquidity as a basic confirmation for a manipulation move to take out some of this, and if by some form we manipulate towards this high resistance liquidity, I can maybe expect that this will, I can maybe expect that this will go down again as our supposed high resistance liquidity has just been targeted. Now let's see some examples in the charts. So this first example is a liquidity sweep. As you can see right here, we got this wick. And then this candle swept this candle's wick, this candle's low wick, and then it delivered up, as you can see right here. Right now, these sweeps can be with wicks or candle body closures, but you gotta identify them. They are separate things. Normally, not always. Normally, when a candle sweeps with a candle body closure above, like a little bit, like this 20 points below, for example, if a candle body closes below, in this example, if it closes below 20 ticks, 20 ticks, not 20 points, 20 ticks, then it basically can be a liquidity run, and we don't want to look for that liquidity sweep. But there are a lot of ways to target that. To learn of that. Now, where is it? Okay, right here. So this is the only example I got for the equal highs. I don't have equal lows, for example, but for example, as you can see right here, equal highs, basically relative equal highs, and this could be our relative equal lows, as they are close of being equal lows, but not surely, not confirmed that they will be equal lows. Now let's see some more examples of other concepts. All right, so as you can see right here, we got this high resistance liquidity. Why is this one high resistance liquidity? Because as you can see right here, our bias was bullish because price was pushing up. And then we got this huge impulsive move down, huge displacement move to take out all of this internal range, internal range liquidity. This is upside. Wait, this is messed up. It's like this. I wrote it bad, sorry. I was getting kind of confused. So it's called internal range liquidity. Price just manipulated to target all of this internal range liquidity. And then this low marked our high resistance liquidity. And all of these wicks, as you can see right here, all of these little wicks are basically called internal range liquidity. And when they are combined to make things easier, they're just called low resistance liquidity, which, as you can see right here, price manipulated down. It pulled back in towards these low resistance liquidity lows, and then it inversed right after, right? So these are basic concepts. And now this high right here, why did I not consider this as our high resistance liquidity? Because I knew this had to be taken out, because first off, our bias was bullish, and second off, this huge displacement candle is normally what is called a manipulation, and we want to inverse that as soon as possible because, as I said, we are bullish, and this is going to mark out our low for this manipulation move. Now, let's check out buy side and sell side. So, I did not mention this. So internal range liquidity, as you can see right here, these little wicks, they're not low resistance liquidity because there are not as many wicks as you can see right here. Therefore, that is why it's just called internal range liquidity. Now, external range liquidity, as you can see right here, this is our buy side, our sell side. And it just means that is external, so it's off the range. It's not inside of this range, therefore it's outside, called external. Now, let's look at some buy side and sell side examples. Now, the buy side was our target. As I said, we were bullish, and then price impulse down, creating that manipulation move. It started accumulating a little bit, then it manipulated once again with equal lows, as you can see right here. Price swept the sell side with this candle body closure and then this wick to sweep out this candle's body, this first sweep of the candle body closure, as you can see right there, targeting the buy side liquidity once again. We could have entered off of this change in state delivery, as you've seen from my previous video, and from this inversion for value gap, as well as you've seen from my for value gap video. So yeah, if you understand these concepts, trading will get a lot easier. Now, I don't want you to go into charts and just start like drawing lines and drawing everything on every wick you see, because I mean that is just the road to unprofitability. Because as I say, you want to make trading as easy as possible, because trading is already a complicated thing, and when you're going to overcomplicate a thing that is already complicated, is going to make things even worse, and you don't want that. Therefore, you're only going to draw you're only going to draw lines on the wicks that matter. For example, on the external range, on the high resistance, on the buy side, sell side, on the equal lows, on the liquidity sweeps. You don't have to draw the internal range liquidity or maybe even the low resistance liquidity. You just gotta know and identify. If you see, oh, that's it, I don't have to draw just to check that is there. For example, I can tell that these wicks are the internal range liquidity, but now I'm not going to draw a line on every single wick that I see, because I know by fact this is an internal range liquidity because I can see. Right? That's basic. So this, as you can see right here, is our high resistance. This is our high resistance liquidity, our high resistance low, and this is our buy side that we want to target, because what are we in? A bullish trend. Why are we in a bullish trend? Price swept previous liquidity and previous low resistance liquidity. Price then manipulated up. Price distributed up and then impulsed up again. Now is creating the manipulation move, probably sweep this lower resistance liquidity and then go back up. So yeah, these are pretty basic concepts. I talked a lot, and yeah, my English is not that good, so like in my explanations I may be like I may confuse some words just because I want to improve my English as well, but I mean, this is a full English channel, and just bear with me with my English. I mean, you can use captions if you like, but yeah, that's basically everything that you need to know about liquidity. Now, if you trade the power 3, you could check my backtesting videos. I have one posted. I will post another one maybe on Monday. I'll see what I can do. Maybe on Monday, I'm not sure. I want to, not sure though, because I will have to study tonight as well. It's going to be a long study session. And I'm also developing the Power 3 Encyclopedia, as I mentioned in the beginning. But I want to make videos, and I want to teach you guys, and I want to be a better trader and a better person overall, because I want to make things free, make things perfect, and teach people for free without any minor setbacks or anything like that. Now, this is a lot of information. I mean, you gotta pause the video, maybe go back again, maybe write notes down, something like that. Take notes of what I'm saying, because these concepts are going to be really useful for your trading journey. So please bear in mind that you will have to study these. This is just the introduction. You can see more specific videos on buy side, sell side, for example. But this is basically the introduction, and this is everything that you need to know about trading is in liquidity. Because what does price want to do? It always wants to do two things. First off, it wants to target imbalances in price, which is the fair value gaps, which is the gaps, and it wants to target liquidity, either it being liquidity grabs, liquidity sweeps, and everything like that. So yeah, you guys learned this, and I hope you have a great day, and God bless you, man.